The Little Book of Common Sense Investing by John C. Bogle isn't just another investing guide filled with complicated charts or promises of quick riches. Instead, it's a heartfelt, deeply reasoned plea to ordinary investors. Trust in simplicity, avoid the noise, and let the power of compounding and low costs work quietly on your behalf. Bogle's message might seem simple on the surface, but as he patiently unpacks throughout the book, its power lies precisely in that simplicity. A quality often dismissed in the investing world obsessed with the illusion of complexity and secret strategies. Bogle opens the book by asking a timeless question. If owning stocks which represent real businesses generating real profits can grow your wealth over the long term, why do so many investors end up disappointed? His answer is both sobering and liberating. Investors, he argues, fail not because the market itself fails, but because they chase returns, trade too frequently, fall for hot tips, and most damaging of all, pay excessive costs to fund managers who rarely outperform the market after fees. The cure, he insists, isn't to find smarter fund managers or more exotic investment products, but to own the entire market through a low-cost index fund, stay invested, and let the magic of compounding do its work. The heart of Bogle's argument revolves around what he calls the relentless rules of humble arithmetic. He demonstrates with striking clarity that investing is a zero-sum game before costs. For every investor who outperforms the market, another must underperform. But once costs are subtracted, management fees, transaction costs, taxes, the average investor must underperform the market by the amount of those costs. In this sense, cost isn't just a small detail. It's the dividing line between long-term success and failure. And because actively managed funds typically charge much higher fees than index funds, most investors in them inevitably lose ground over time, even if a few lucky managers do outperform. To bring this point to life, Bogle uses historical data showing that over long periods, the average actively managed mutual fund fails to beat its benchmark index after fees. Even more telling, the small minority that does succeed in one period rarely repeats its success in the next. This inconsistency, Bogle argues, isn't a flaw of the system but its natural outcome. Markets are largely efficient, and any edge a manager might have is quickly eroded by competition and costs. So instead of trying to pick the next star manager, a task even professionals struggle to do, investors would do better by accepting average market returns through index funds, which, thanks to their low costs, consistently beat the majority of actively managed funds over time. Bogle doesn't stop at numbers. He also dismantles common illusions that tempt investors away from this straightforward path. One such illusion is market timing, the belief that an investor can jump in and out of the market to dodge downturns and catch rallies. Time and again, Bogle shows, even experts fail at this game because predicting short-term market moves is nearly impossible. Investors often find themselves out of the market when it unexpectedly surges, missing out on critical gains that drive long-term returns. For Bogle, the right answer isn't to guess when to be in the market but to remain in it, patiently and consistently. Another illusion is the allure of hot sectors, funds, or stocks. Investors are drawn to recent winners, convinced that past performance predicts future success. Bogle warns that this behavior often leads to buying high and selling low, as yesterday's winners become tomorrow's losers. In contrast, index funds avoid this pitfall because they hold everything: today's stars, tomorrow's surprises, and even the occasional disappointments. Over time, the net effect is that the investor captures the broad market's growth without relying on risky forecasts. Bogle's core philosophy rests on a simple belief: investing should be about owning businesses, not betting on price movements. Stocks, he reminds readers, aren't just tickers on a screen. They represent real companies producing goods and services, earning profits and distributing dividends. Over long periods, the value of stocks reflects the collective growth of these businesses, driven by earnings and dividends. Market speculation may cause short-term swings, but it can't override the steady upward march of business fundamentals. Index investing allows investors to participate directly in this growth without the distractions of speculation. At several points, Bogle contrasts investing with speculation. Investing, in his view, is buying and holding a diversified portfolio of businesses to participate in their long-term success. Speculation, on the other hand, is trying to profit from short-term price changes, often guided by emotion, rumor, or market noise. He argues that most of what passes for investing advice today is, in reality, speculation dressed up in sophisticated language. Index funds, by design, free investors from this trap by encouraging them to focus on what truly matters: long-term business growth and low costs. Throughout the book, Bogle returns to the profound impact of costs on investment returns. Even small differences in annual fees can compound into huge sums over decades. For example, an investor who earns 7% annual returns before costs but pays 2% in fees effectively keeps only 5%. Over 50 years, this seemingly modest difference can lead to a portfolio worth almost half as much as one with lower costs. This tyranny of compounding costs, as Bogle calls it, is the silent enemy of wealth building. By choosing index funds with expense ratios often below 0.1%, investors can keep more of what the market gives them. Bogle also tackles the issue of complexity in investing products. Wall Street, he suggests, thrives on inventing ever more complex funds and strategies: leveraged ETFs, sector funds, hedge funds, all marketed as the next big thing. But complexity often hides higher fees and greater risks. Simplicity, in contrast, keeps costs low and strategies transparent. Owning a total market index fund, which holds thousands of stocks representing nearly the entire economy, offers diversification, simplicity, and low cost in one package. Another recurring theme in the book is the importance of discipline and emotional control. The biggest threat to an investor, Bogle argues, isn't market volatility but the investor's own reactions to it. During market downturns, fear can push investors to sell at the worst possible time. During bubbles, greed can lead them to overextend. Index investing by design helps counter these impulses. With no need to pick stocks or time markets, investors can stay the course, weather volatility, and focus on the long-term horizon. Bogle also addresses critics of indexing who argue that if everyone indexed, markets would become inefficient. He points out that active managers still play an important role in price discovery, and it's unlikely indexing will ever dominate to the point of destabilizing markets. Moreover, the success of indexing doesn't depend on everyone else doing it. It simply relies on the math of low costs and market averages. One of the book's most endearing qualities is its author's humility. Bogle, despite his enormous success, doesn't promise readers that they'll beat the market or become wealthy overnight. Instead, he promises something more meaningful: a straightforward, low-stress path to participate in the long-term growth of businesses without falling into the traps that ensnare so many investors. He invites readers to accept average market returns, which, thanks to low costs, can become above average compared to most investors who pay more and chase fads. Bogle's advice also transcends markets and numbers. At its core, the book is a call to rethink what investing means. It's not a contest of cleverness or nerve, but a patient, disciplined effort to build financial security over a lifetime. His focus on long-term thinking, cost awareness, and simplicity offers readers a sense of control in an uncertain world. In later chapters, Bogle touches on bonds and asset allocation. While stocks offer the highest returns over the long run, bonds provide stability and income, making them an essential part of a balanced portfolio, especially as investors approach retirement. Even here, Bogle favors low-cost bond index funds over actively managed ones, emphasizing the same principles of diversification and low costs. By the end of the book, Bogle has gently but firmly dismantled the myths that keep investors chasing illusions: that the right manager can reliably beat the market, that timing can protect investors from losses, or that higher costs buy better performance. What remains is a clear, common-sense path. Invest in a broad index fund, keep costs minimal, diversify widely, stay invested, and let time and compounding do the rest. The little book of common-sense investing stands out because it isn't just about what to do but why to do it, and why so many fail by ignoring these truths. Bogle's writing is both analytical and deeply human, shaped by decades of experience and a genuine desire to protect investors from Wall Street's excesses. His vision isn't glamorous, but it's profoundly effective. Own the market, keep it simple, minimize costs, and don't let short-term noise shake your resolve. For readers, the book is more than financial advice. It's a gentle roadmap to peace of mind. Instead of worrying about daily market moves or the next economic headline, Bogle's approach frees investors to focus on what truly matters: building a secure future through disciplined, low-cost investing. In doing so, it offers not just higher odds of financial success, but also the priceless gift of simplicity in a complicated world. In the end, Bogle's wisdom boils down to this. The simplest and most efficient investment strategy is to buy and hold all of the nation's publicly held businesses at very low cost. Over time, this approach doesn't just match the average market return. It beats most investors weighed down by costs and poor timing. And while the strategy might seem unexciting compared to Wall Street's promises of market-beating gains, its quiet power comes from what matters most: common sense, patience, and trust in the growth of businesses over time.